So in this video, we're looking at a bull put and a bear call credit spread and how to manage these credit spreads when things go right, when things go wrong, and how you have to kind of manipulate them at expiration to limit your risk. Let's start first with a bull put credit spread, looking at this scenario where, let's say the stock price starts at 120, and then for whatever reason, it goes down and it blows past both of these levels. It goes past 110. It goes past 105 and it settles down at the bottom at $100 per share. This is the worst case scenario in terms of the capital that's going to happen to this trade. You're going to lose money in this trade, but you're not going to lose the ultimate amount of risk, which I'm going to show you on the next example, which is the one you really have to pay attention for. So this one's pretty straightforward. If the price went down to $100 per share, right? What would happen in this scenario? Well, in a negative connotation, this put right here, right? The 110 put, when you sell a put, you're taking on risk of being assigned shares, okay? So you would get assigned on the Saturday after this put expires, or after this bull put expires, you'd get assigned 100 shares at 110, 100 at 110. That's in your account, okay? That's what happens. So what you'd have to do, right? If those are in your account on Saturday, Monday you could turn around and sell them for $100 per share, but then you're going 110 minus 100 equals $10. So you're going to lose $1,000 per share. 0, 0. Yeah, $1,000 per share is going to be your total capital loss. If you ended up waiting until Monday to sell these shares in the open market, $400 per share, assuming, right, that this stock price opens up at $100 on Monday morning. Because don't forget, these often get assigned, after hours options get assigned to your account on Saturdays. So you're taking on some risk by waiting till Monday to go ahead and get this back in the hopper and close your position. Alternatively, what you can do to protect your downside risk a little bit better is this. You still get assigned 100 shares at 110, but before this contract expires on the Friday, maybe that Friday at 3:30, 3:45, whatever it would be, you'd want to go ahead and exercise this bot leg exercise, right? And this is assuming that the stock price is already at that $100 level. It's very, very obvious that it's going to stay there and it's going to be below this 105 right here. So what you would do is you would exercise this on the Friday before close. So what you're doing when you have this 105 put is you're giving yourself the ability to sell 100 shares at 105. So this becomes your step one right here. You sell 100 shares at 105, or you, in this case, short the stock at 105 at Coinbase. Then on the weekend, step two comes in, and this automatically, this comes in, it's going to assign you shares at 110, but this is going to be a buy, right, at 110. And that's going to cover your position. You're going to net out at a $500 loss, which is just the difference between 105 and 110, $500. But if we look at and take our premium from over here, $76 that we got to do this trade, we can plug this in right there, 76, and just kind of just mitigates our loss a little bit. So instead of $500, we go down instead to 424. Right? So it's a little bit less risky to do this as long as you remember to exercise this position prior to the contract expiring. If you don't, again, you're opening yourself up to relying on this price to be there Monday for you to close out your trade and do this part of the trade, the selling of the trade. This buying is going to happen to you no matter what. You're going to get assigned these shares. So you might as well exercise this and get them in the hopper so you can protect your downside, limit your loss to 424 versus an unknown amount waiting on this stock price to open up on Monday morning. That's scenario number one. Now, scenario two, very similar, but with a little bit more of an intricacy. And this is what happens when the stock price starts at 120, it goes down to 110, and then it settles right there at 107, just like you don't want it to. So we got 107 there. And this puts us in a bit of a pickle because we've got our 105 range right here waiting to be used. We've got the 110 over here, which is definitely still getting assigned, and it's right smack dab in the middle. So what happens now? Well, this is where it gets a little confusing and potentially very risky if you don't understand what's happening. Again, on the Saturday after this expires, or even the Friday evening, depending on when it happens, this put is going to be sold to you. So you're buying at 110. You're buying 100 shares at 110, okay? So you're down about 11,000, 11K. Now, you just, because it's expired again, you lost the ability to use this part of the contract. You can't do that. So what are you left with? Well, if the market was still open, you could turn around and sell at this 107 mark. But as we just said, this kind of stuff happens. This assignment happens most often after the market closes. So you're left in the tough scenario of having to wait until Monday again, kind of with your D in your hand, if you know what I mean, just waiting there till Monday and hoping that this price is still there, that you can then sell at 107. But if this keeps dropping to 100, 90, 80, you get what I'm feeling here? Like it's risky, and it's gonna go all the way down to, let's say, $70. And then you're into it at 110, you're out of it at 70. That's a $40 per share trade. You just lost 4Gs real quick because there was no proper risk management in this scenario. So if you can't access this part of the trade and you see the price kind of hovering in between these two, I think most traders would advocate towards just closing down the entire position. Just take it all off. You're going to have a less capital loss than dealing with all this crap down the way down. So just close the whole coin bull put out, take the capital loss, and just move on. That's easy risk management 101. That's how you do it right there. And that would be my preferred solution as well, just to take risk off and not worry about it going into the weekend. But that one kind of trips people up sometimes because they see, oh my God, I got assigned at 110 and now it's trading at 100 and I'm going to lose all this money and I can't get out and I can't do it. And it keeps going down. And that's when people really start freaking out. Maybe you get a margin call. Maybe your account's not built and set up properly for you. You don't know what's happening. So you don't know how to execute and get out of it. So either close out the trade early or even look to exercise and use this and still take on that $500 capital loss. But you're eliminating your risk when you use this or you close out the trade in its entirety. And when the trade works out and it's a 120 level, and maybe it can go all the way down to 110 and 1 penny, right? You're good. You're going to make some cash. If it stays up at the 120 level, you're good. If it doesn't drop below 110, you're going to be in a good spot here because you're going to get to keep this premium at 76, right? It paid out this baby right here. This expires worthless, or you don't exercise it. So you keep the $76 and you go and you repeat and you do it over and over again to infinity and beyond right there. That's the best case scenario. The stock price stays up and or rises. And this is where you're making money very quickly with the bull put strategy. So that's for a bullish market and the scenarios that can happen there. Now on the flip side, when you have a bear call. So with this trade then, starting it up, maybe the stock price is at 490 and we want it to go obviously down. But let's say that it doesn't. Let's go worst case scenario, capital wise, not risk wise, capital wise in this case. And let's say that it doesn't go from 490, it goes up. And it goes up all the way to 520. Okay, 520 is going to be our magic price here. Let's box that off so we understand where it's going. Now, at expiration, again, we have some things that are going to happen. We have something to do before expiration to make sure we protect our downside risk. When you sell a call option, you are giving up the right to somebody else to buy 100 shares from you. Okay, so on the Saturday after this expires or whenever on the weekend, this is going to happen. You're going to sell 100 shares, right? At 500 per share. So see you later, 500 shares for 100 shares. If you have them or not, like that's going to happen. You're going to sell. That's just the way that it works. You're going to be exercised and it's gone. So you can, if the market was open, you could buy back at 520 and you'd have a $2,000 loss, which isn't ideal. Again, and this could go up to 530, 540, 550. So that's not the real way you want to play it. What you want to do in this scenario, or what the pros would tell you to do, is you use this part of your bear call, right? So you do this first. And what you're going to do is make this your step one by exercising this, right? You're going to exercise the X, just like in the gym, lifting the weights, baby. Exercise the 510 call. And start off and make this number one on the Friday afternoon, 3:30, 3:45, buy 100 at 510. Okay. And it says when you clearly see this price is like way below this 510 area, or maybe when it's flirting with it, you want to do this. You want to exercise this, buy at 510, sell at 500. Then your capital loss is only $1,000, right? And also you can take into account that your premium there at 124 would though would go to offset some of the damage. So end up being roughly what, like 8. Let's make this red for loss, negative 876. So not terrible considering it could be a lot worse when you sell at 500 and have to buy at 520 or again 530, 540. So when it gets close to expiration and it's dropped hard, I mean, you can also close off the trade in its entirety. Again, that's always an option. If you don't want to do that, exercise, get those shares in your account, flip them for a smaller loss, have your premium offset some of the loss as well, and walk away and live the trade another day. Now, if the stock price gets funky on you for scenario number 2, again, we end up right in the middle of these two bad boys. What you going to do then? What you going to do when they come for you? We'll see. Stock price is going to end up at 505, okay? That's where it's in, smack dab in the middle again. I'm going to draw this out so you can visually see a little bit better where this is going to land, right? You've got your 500 here. Boom, goalpost, goalpost. And now it's right stock dive in the middle. So that's not where you want to be. This is maximum potential kind of risk on because what's going to happen, expiration, right? So here's what's going to happen. You're going to sell 100 shares at $500 stock price. And that's going to happen regardless. It's going to go, it's going to be a done deal, right? Sell 100 at 500. That's in the hopper, okay? Can't stop that. That's this part right here. Because the price went and crept above that. Now the bot 510 call. Normally you'd use this to protect your risk and kind of close out the trade and protect the margin and the safety net. You're not going to want to do that because you're looking at the price of the stock and you say, oh, price of the stock's 505. Why can't I just buy at this, right? And then my loss is $500, so it's not a big deal. Well, again, because this assignment won't happen till Saturday or Sunday or the weekend, right? You're not going to have the opportunity to go in and make this secondary trade. This is what happens first. Part number 2 has to wait, you guessed it, until Monday. And that equals a big fat risk sandwich. We do not like risk sandwiches in the options trading world. They have the ability to blow up accounts and make people very, very sad. So what you want to do instead is not put yourself in this scenario because, again, why is this risky? Well, it's risky if the stock price goes from 505 up to 600. You don't know if the stock just goes on a crazy heater. There's big news. There's a merger acquisition. Who knows? If it goes up to $600, you sold at 5. You have to now buy back to cover at 600. Now you're $100 per share out. You're taking on a 10K loss on a trade that you could have just closed out on Friday afternoon for a few $100 and saved yourself the headache and the risk of doing this. So my advice and how I would play this one in my own account, maybe not my advice, but how I'd play this if I was in this scenario, I would close this trade out on Friday afternoon. If it was kind of threatening to be in between these two levels, I close out for a capital loss. I take it and I move on to my next trade. Don't play this game. It's not worth it, in my opinion. And of course, we've got 490 start. Maybe it goes up a bit, hits 499, and then comes back down and goes down to 485. All good and all acceptable in our best case scenario where we just keep our premium at 124. That is our profit, right? As long as the stock price stays below 500, expires worthless. We wouldn't utilize this piece either. We keep our 124. We look to repeat this trade. And again, our infinity loop gets complete because this is a major check mark and a major win based on where the stock price goes for the bear call. So the main thing for both of these, and I hope you got some value to this video, smash the like button if you did. The main thing for both of these is to just manage this monster right here. Don't get greedy. You can manage this and you can take and accept small capital losses from time to time. You will give yourself many more chances to hit home runs and hit things out of the park. You just have to make sure you manage this and give yourself more at-bats to do so. Thank you so much for sitting through this demonstration and hopefully getting some value out of this lesson. If you want to see more content like this, stock investing, different interactive broker tutorials, and more, check out the channel, subscribe for more, and I will see you on the next one.